Have you ever signed a life insurance application and then wondered, what happens now? It kind of feels like it goes into this giant black box, and then weeks later, a decision just appears. Well, today we're going to pry that box right open. We're breaking down the entire mysterious process using the fantastic insights from Dr. Sudinkar SG as our guide.
Right. So you've done your part. You filled out all the forms. You gave them your details. You signed on the dotted line. But what really goes on in that quiet period between your signature and that policy showing up in your mail? That, my friends, is where the real action begins.
That whole secret process is called underwriting, and it's basically how insurance companies figure out how risky it is to insure you. And here's a cool bit of trivia. The name itself is super literal. Way back in the day, an official would actually write their decision, their signature, under all the proposal details on the form. So, underwriting. Simple name, really complex job.
But why do they have to go through all this trouble? I mean, why can't they just take everyone's money and issue a policy? Well, it turns out underwriting isn't just a bunch of red tape, it's the absolute gatekeeper that keeps the whole insurance system running fairly for everyone.
Underwriting really has two huge jobs. First, it stops something called adverse selection. Basically, that's preventing people who already know they're a high risk from suddenly buying a ton of insurance. And second, it makes sure there's equity. This just means that people with about the same level of risk should be paying about the same price. It keeps things fair.
I love this analogy. Adverse selection is like trying to buy fire insurance after you already see smoke pouring out of your attic. You know something the insurance company doesn't, and you're trying to get coverage right before a disaster. It's an unfair advantage, and underwriting is there to sniff that out. And this table here really shows why that fairness, that equity, is so important. Picture this. You've got a big pot of money, a premium pool funded by 99 healthy people. Everything's stable. Then a 100th person joins, but doesn't mention a serious heart condition. They pay the same low price as everyone else, but if they pass away early, their huge claim gets paid out from that same pot. What happens? The whole fund gets unfairly drained, and the other 99 people might have to pay more later to make up for it. Underwriting is what prevents that from happening.
So who are these gatekeepers anyway? You might picture one person in a quiet office making the call, but the truth is, the review process starts way earlier than that. It actually starts the second you start talking to your agent.
It's really a two-step dance. The first level is out in the field. That's your agent. They're the ones gathering all the initial info from you. Once they've done their part, it moves to the second level, the underwriting department at the main office, where a professional underwriter takes all that data and makes the final decision.
And you shouldn't underestimate the agent's role here. As Dr. Suvendra SG points out, the agent is so critical that they're often called the primary underwriter. They're right there face-to-face, so they're in the best position to see if everything adds up and to spot any red flags before the application even gets filed. Okay, so we know who's doing the assessing and why they're doing it. But now for the real question. What are they actually looking at? Let's dive into the underwriter's checklist.
The main goal of this whole process is to put every applicant into one of four main buckets. You've got preferred risks. Those are people who are even healthier than average and might get a better price. Then you have standard lives, which is for average risk. Substandard lives are folks with higher risk who can still get insurance, just maybe with some changes. And finally, declined lives for risks that are just too high to insure.
So how do they decide which bucket you fall into? Well, they look at a whole combination of things. They look at your age, your financial situation, what you do for a living, your personal habits, and of course, the big one, your medical history. Let's touch on a few of these.
First up, financial standing. The underwriter is basically asking one simple question. Does this policy make sense? For example, if someone making 5 lakhs a year suddenly tries to buy a policy for 3 crores, that's a massive red flag. It makes the underwriter wonder, why so much coverage? It signals what they call a moral hazard.
Next up, your job. And yeah, it matters if you have a desk job or if you work in a danger zone. They look at a few things here. Accidental hazards, like if you're a miner, health hazards, like being around chemicals all day, and even moral hazards for jobs that might be linked to some shady stuff. And of course, they look at your personal habits. Smoking is a huge one. It will almost always mean you're paying a higher premium. Same goes for long-term heavy drinking, which just increases risk all around. And any history of substance abuse? That's a major red flag that could get an application declined on the spot.
And now we get to the part everybody thinks of when they hear underwriting, the medical review. This is where they really get into the weeds to build a full picture of your health, both now and in the future.
So what are they looking for? Well, your family history is a big one. Things that might run in the family like heart conditions or certain cancers. They'll also look at your own personal medical history, any major illnesses you've had. And then there are the basics, like your height to weight ratio and your blood pressure. It all helps paint a picture.
All right, after looking at everything, your finances, your job, your lifestyle, your health, the underwriter has to make a final call. So what's the verdict going to be? It turns out there are 7 possible outcomes.
First up, the best case scenario. You're accepted at ordinary rates. This means you're standard risk and you get the standard price. Simple, straightforward, no fuss. You're in.
Then you've got the yes, but answers. If you're a higher risk, they might still insure you, but with some conditions. Maybe they'll charge you an extra premium. Or they might apply something called a lien, where the full payout only happens after a few years. They could also add a special clause or even offer you a completely different type of policy.
Sometimes the answer isn't yes or no. It's not right now. An insurer might postpone your application. This usually happens if you've just had a medical issue or procedure. They want to wait and see how things go, make sure there are no complications, before they make a final decision.
And last, the application can just be flat out declined. This happens when the risk is simply too high for the insurance company to take on. Think of someone with a very advanced serious illness. It's an unfortunate outcome, but it happens.
So when you boil it all down, underwriting isn't about finding reasons to say no. It's a really delicate balancing act. It protects the company for sure, but more than that, it protects all the other policyholders by making sure the system stays fair and the money is there when families truly need it.
And that leaves us with one last, really fascinating thought. We've just walked through a process that's very human, very analytical. But what happens next? In a world of big data, fitness trackers that monitor us 24/7, and incredibly powerful AI, what does the future of risk assessment even look like? It's a wild thing to think about. Thanks for tuning into this explainer.